Grishma, that we are live.
Good afternoon, all participants and panel members. A warm welcome to today's session hosted by DirectX Committee ICI. It is indeed a pleasure to have you all here. Under the expert guidance of Mr. Gaurav Singhal, we have a unique opportunity to dwell into the intricate nuances, recent major changes, and developments in the field of international taxation. Mr. Gaurav Singhal is a renowned professional and brings with him a wealth of experience boasting over 19 years of specialization in corporate and international taxation. With an impressive career that includes pivotal roles in esteemed organizations such as BMR Associates, KPMG, and EY, Mr. Singhal's expertise is unparalleled. Additionally, as a co founder of Saksham Ventures and heads up consulting, he continues to contribute significantly to the knowledge and professional services domains. His stature as a regular speaker in seminars organized by prestigious forums like ICAI and IFA, along with his frequent invitations from companies and law firms to train their employees, speaks volume about his expertise in the field. We are truly honored to have you, sir. Your presence enriches our session immensely. Before we invite Mr. Gaurav Singhal to share his valuable insights on the topic, I would like to invite CA Piyush Chachad, Chairman of DirectX Committee ICAI, to address the audience and provide opening remarks, followed by Mr. SP Singh, ex-IRS officer, to provide an overview on the session.
Thank you very much, Grishma. A very good afternoon to all of you. Rather good evening. Welcome you back to this webinar, weekly webinars, which Direct Tax Committee is hosting under the Institute of Chartered Accountants of India. Gaurav Singhal, the learned speaker for the day. SP Singh Saab, the senior faculty, always a speaker, always available to Direct Tax Committee. Grishma Modi, the moderator, and who also is an expert in international taxation. I'm sure this will be a wonderful combination, and the topics, that is recent amendments in international taxation, would be quite insightful. My vice chairman Kota S. Srinivas has also joined, and my secretary team of Direct Tax Committee, and the members, esteemed members of our institute who are online. Very warm welcome to all of you. Coming to our initiatives, I thought in my opening remarks, I'll try to cover up the initiatives of Direct Tax Committee, specifically on a broader perspective, as well as on International Tax Committee. As you may be aware, since last 2 years, this is the second year where Direct Tax Committee has now been merged with International Tax Committee. Initially, there were two different committees when it comes to the Institutes Committee's role. Now both have been merged. As an action plan for this year, Direct Tax Committee, we have taken two very important subjects. One is coming up with the guidance note on 10B and 10BB, that is an audit of charitable institutions. You may be aware that last year we came with a technical guide, but this year we have been working upon the same to convert into a guidance note, because the authority attached to the guidance note is at higher pedestal when it comes to authority attached to a technical guide. So the guidance note are more of mandatory nature, though it may be called as a recommendatory, but it requires the members who are actually performing an assurance function, they need to follow that. If they are not following that, they need to document the reasons, what are the alternate audit procedures that they are following. So you would be looking forward to a guidance note, which I believe maybe in 2-3 months time, it's our target. Groups have informed, people are working upon that. Once the guidance note draft is approved by the Direct Tax Committee, the exposure draft will be released for the purpose of the public comments. And once that is finalized, then it will be released for the use of the public as such. Coming to another aspect, as everybody knows, the amendment has been made in Form 3CD. Certain clauses have been amended. Most importantly, 43 capital B subclause H has been introduced. We do not think that we will be able to come with a guidance note, but definitely will come up with an implementation guide for the revisions which have been made in Form 3. Again, the working has already been started on that. It may be in another 2-3 months time before the assurance function and before the working or before the audit really starts, tax audit really starts. Our target is that this publication should come in. Again, as I said, we may not come with a guidance note because that requires much longer time period. And of course, the guidance note, generally, we would like to amend our existing guidance note when the budget comes in, which is not expected before June. So after budget coming in, converting it to a finance act, it may take some time. So meanwhile, we are working upon the implementation guide for the revision and form, which you can look forward. We had a meeting on the third aspect. We had a meeting with the CBTT chairman last week on the 6th of March. and we had a purposeful discussion on the pre-budget memorandum. And again, we will be meeting them maybe in the last week of March or maybe first week of the April, whenever the pre-budget memorandum is finalized. We have already drafted from a DTC side, and we are also seeking comments from the various members if they have any particular suggestions to be included in pre-budget memorandum. Any of the participants who would like to contribute on the same, you please do write your suggestions on dtc@ici.in. We'll look into it, discuss it, and try to incorporate in the pre-budget memorandum, and also personally discuss when we meet the CBDT representatives or the representatives from the tax policy department. In that meeting, obviously, we had also discussed that now we'll be having a quarterly meetings with them to discuss the issues which our members generally face in relation to the tax returns, tax computations, tax assessments, and those representations we can discuss verbally on a quarter-to-quarter basis when the meeting will be held with the policy department. So we have decided, CBDT chairman has assured that on quarterly basis we'll have those meetings and try to thresh it out. Apart from meetings, obviously we are already making representations time to time whenever we get feedback from the members or whenever something comes up in the public domain that the representation is required to be made in regard to the issues which are faced, challenges which are faced by the members or the assessors, we do make a representation to on that. On an international tax fund, obviously recent amendments will be discussed today. But as you may be aware, the Direct Tax Committee has a course which is called Diploma in International Taxation. It's a diploma course wherein you can register yourself and you will have to appear for an examination. An examination is conducted in a manner wherein the CA examinations are conducted, and you have to appear, and once you clear, you may get a diploma in international taxation, which is quite valuable certificate. I'm sure it will give you a good recognition if you want to really practice or excel in the international taxation. So all the members who have not availed this or who have not enrolled themselves for diploma in international taxation, my suggestion to all the members would be, please look into that. Please look into a syllabus. You may also speak to the people who have already done this course, and you may register for the same. During this year, obviously, we do plan this diploma course happens in both manners. There are physical courses also and online courses also. In online, our maximum participation is restricted to 200. So on a first come first serve basis, whenever we launch this courses, if the 200 members get registered, we stop for the registration. And generally, all these online diploma courses are always jam packed. We always get registration beyond 200, and 200 is always achieved. Similarly, for physical batches which are conducted in the metro cities, the limit is the minimum 40 members participation. In tier 2, it is 30 members. So we'll be launching soon. My request to the members, please look if any physical courses are coming in the cities where you are placed, or you may also request your local branches. They may get in touch with Direct Tax Committee, and we will arrange a physical batches also whenever required. Similarly, otherwise you can avail that online facility. Similarly, there's another certificate course, unlike Diploma of International Taxation. For an UAE corporate tax, we had come with a certificate course last year, wherein we have got a very good response. That certificate course is also done online and physically. Physically, it is done in UAE, wherein majority of our members who are practicing over there, they get themselves registered and avail the certificate, and they get a benefit out of it. Similarly, the similar course, same course is also done online, wherein people from India are registering. We have seen generally the participants are the practicing chartered accountants from India. So you may look into that if you feel it would be appropriate. It may be helpful to you for your future planning. If you want to move somewhere abroad, or even if in India you are there, you can always provide services in this regard. You may register yourself for such UAE corporate taxations. Apart from this, we keep on giving certain representations or the public documents of OECD and UN. Whenever it comes, it has been discussed at the committee level. Experts from the international taxation do give their comments and suggestions thereon. After that, it is discussed at the committee, and then they have been sent to OECD or United Nations. This year, one more important thing which we have decided, we would be coming out with the research paper on the various certain topics of international taxation. We have decided 4 or 5 as of now, which is like on anti-avoidance agreements, anti-avoidance measures, beneficial ownership under tax treaties, then foreign tax credit mechanism, rules of interpretation of tax treaties or a bilateral agreements under Vienna Conventions, sign then the scope of royalties and FTS. And for this purpose, in fact, last week itself, we had invited expression of interest from various members who would like to write a research paper or be part of the group who is preparing this research. If any of those members who are actually present today and they would like to become part of those groups, please do respond to those particular emails. And if even if you have not received an email or a Google form, you may write to dtc@ici.in. I'm sure the committee will consider and will rope you in. And if you are serious about it, because it would be a research paper which requires a lot of study, it helps you in studying it, it helps you in making yourself also an expert. And that research paper is actually been respected well by across the globe, who are people who are practicing in international taxation. So with this, obviously, thank you very much once again for joining this afternoon, this evening, I would say. And I would also thank you once again, Gauravji, for accepting to our request, which always he has been at the forefront. Thank you very much. Thank you, Grishmaji. Thank you very much, SP Singh sir. Over to you, Grishma. Grishma, you can take the proceedings ahead.
Yes, sure. Now request Mr. SP Singh ji to just give us an overview of the session.
Thank you, Garishma, and thanks a lot, Piyush ji and Kotya ji, and good evening to all the friends. It's always pleasure interacting with the young mind, vibrant persons, which give me always opportunity to learn. I was just wondering, I mean, whether you may be just looking at the heading of the topic which we are going to discuss, and maybe thinking what's the need of putting recent before changes in international taxation. International taxation, okay, changes are there. Why do we keep on putting this word recent on and on and on? In 1917 also, we must have put it recent changes. In 2023 also, we have put recent changes. What's the logic behind that? And today's discussion will revolve around the logic which I would like to discuss with you. The question which comes to my mind, I mean, it's my own way of looking at the meaning of taxation. What is taxation? At the end of the day, taxation means the government's share in the activities and knowledge. And finally, on the capital which is constituted by the activities and knowledge. So activities and knowledge, once they are transacted, they give rise to income. If they are kept for some time or come for other purpose, create turn into capital, then again, I mean, that is subject to capital gains tax. That's across the world. Now, when we look at the definition of this taxation, that it is the take of the government in the profit which is arising because of the activities and knowledge, the question which would be coming to your mind is that what are the factors which are influencing these activities or knowledge? The factors which are influencing the activities and knowledge are globalization and digitalization. These are the things, these are the two factors which have been in a very, very significant way affecting our actions, affecting our knowledge, affecting transfers in our actions, and affecting transfer of our knowledge. And these are not static. The globalization and digitalization depend upon technology's development. And as the technology develops, right from the agricultural revolution days through to industrial revolution, and now in the revolution of knowledge, these have been changing. Now, the consequence of these changes are the way the business is conducted. Gone are the days when brick and mortar policy or the way of doing the business was the way, I mean, business was conducted. And consequently, the companies which topped the list of maximum wealth companies used to belong to those generation or those type of companies. In the recent years, It is the digital companies which have replaced them. And that goes on to show the strength of those companies which are the multinational enterprises in framing or in positioning our thinking and the policy which is developed by the authorities across the globe. Now, when we look at these factors, who can exploit these maximum? Those are
Yes,
the
you said
companies.
something.
Hello. So those are the companies which have their branches, which have their limbs in different countries, which we call multinational enterprises. They have the resources and capabilities to shift the profit from one location to another. Not only this, due to the development of internet and the transactions in knowledge being carried out through internet, it or even the actions or the activities being conducted through internet, it is no longer required that to carry a business in a location, a company should have a physical locations. So the definition of the site's source country has undergone change. To what extent a country can tax any income is under threat. And this has given rise to the worries across the globe. G20 and the OECD have put their mind together and are developing the approach to deal with the digital economy. And this has given rise to two pillar approach, pillar one and pillar two. Under pillar one, the effort is to ensure that there is a fairer distribution of profits, and pillar two seeks to ensure that a minimum amount of tax is paid in all the jurisdictions where the actions are taking place. The other thing which is happening is that in our country, where the law is developed not only by the policy makers but by the judiciary also, they are dealing with issues which were not present earlier, or the law for them were not sufficient to deal with them. Now, let us take one prime example is the development of technology, development of know-how and things like that, and the trading in that which gives rise to royalty. When can the royalty be taxed? The other, let us take a very, very common thing for us, the websites which are developed. Now, there are two things in that. An entity may help me to develop a website. There can be an entity which will provide the platform on which that website can be put. Now, there are two activities. One is helping and developing, and the other one is allowing a certain platform to be used. Which one is to be taxed as royalty and which is to be taxed as fee for technical services or even services? Now, these are the questions which are not very clear and which are not very obvious. Due to this, these matters have attained the level of the High Courts and the Supreme Court. And one issue which is very, very fundamental is regarding the most favored nation. For many years and in all the jurisdictions, certain benefits are provided by a treaty partner to the another treaty partner to ensure that the other treaty partner is not put in an adverse situation and more adverse situation than what the first entity is providing to other countries in the similar situation. That's the most favored nation concept. This concept has been under dispute and had even gone up to the Supreme Court. The Honorable Supreme Court has come out with a decision which has not found favor with many experts across the globe and even in India, due to which review petition has been filed. So this issue is still open for debate and are available for the purpose of coming to a particular solution. Similarly, the question of royalty, when the Honorable Supreme Court came out with the decision in case of ingenious analysis, a view was that now we have some certainty about taxation of royalty. But lo and behold, that issue, that decision is under review. So this is how the judiciary, or this is how the law is developing in India and across the globe. And it is not static. And that is why the word recent has been put before changes in international taxation for this webcast. We cannot have a person better suited to deal with these complex issues than Gaurav Singhal. He is a person who has got very clear concepts about these international taxation issues. I am sure you will be very much benefited when he explains these complex issues. And I very eagerly look forward to the deliberations and whatever way I can contribute to that. Friends, once again, very good evening, and I'm sure you will like today's discussion. Over to you, Garishma. Thank you.
Thank you, sir, for giving such a great insight on recent developments and overview of the session. Now, I request Gaurav ji to just take up the technical session ahead.
Thank you, Grishma. It is indeed a humbling experience to be in the presence of dynamic leaders like Chairman Piyush ji, Vice Chairman Srinivas ji of Direct Tax Committee, the lighthouse for our profession, SP sir, the young powerhouse, Grishma. Uh, I will try my level best to come up to all the expectations which have been perhaps unfairly set in respect of what I'll try to deliver in this deliberation. Today we will cover the contents in these three broad categories. First, we'll talk about what you see right now in the middle of the screen, the India updates, because that I think is the most important from a practical implementation, from a practice perspective, yeah, from an actual ground reality perspective. What are the developments that have happened so far? So, as we said, touched upon the controversy which just doesn't agree to die down, which is taxation of software license fees, taxation of most favored nation clause. What I'll do is I will give you a quick background of what has happened, and then I'll tell you what the controversy is now and how does it affect us. I'll also tell you why this is relevant for us. I'll discuss with you another very interesting decision from the Delhi High Court, which is for the boogeyman of the international tax world, the permanent establishment risk, how it continues to loom, how a concept which is an age-old one still keeps evolving. There are decisions which keep coming up and how they create risks for us. We'll talk about a particular transaction which a lot of people in the country enter into, all of those budding entrepreneurs. Every time that you're booking a domain for yourself, are you required to deduct taxes when you're making a payment for that domain registration? We'll talk about that. And a very interesting controversy which is also brewing is whether a tax residency certificate is good enough if you want to claim a treaty entitlement. We'll talk about what's the status of that controversy. I think this will be the bulk of today's discussion. The next part will be what you see towards the rightmost corner of the screen, which is the developments which have happened outside India, but they are of relevant to Indian businesses. So how the India-Mauritius Treaty is evolving, what is happening in Singapore, of course, what's happening in UAE. Piyush ji talked about the course which is being offered by ICAI. Speaking from personal experience, fantastic course, fantastic trainers. Do go for it if you are interested in something like that. We will also touch upon towards the end the developments which have happened so far on the two-pillar solution, pillar one and pillar two, and how local changes are happening also across the world consequent to those developments. Um, let's first of all talk about the decision which happened some time back. It's not a recent development, right? But there's a reason why we are talking about it. For the longest length of time, this controversy has proved whether payment made for a software license fees, is this something which qualifies as royalty? And therefore, is this subject to tax in India when the person earning this license fees is a non-resident, when it's a foreign company? And therefore, should the payer deduct tax from such payments or not? Now, why is this relevant? As such, the Honorable Supreme Court actually settled this controversy a little while back. But what we're seeing even till date is that there are draft assessment orders which are being passed by the tax authorities in which they do not follow the decision in the case of ESC because, as per the revenue, the decision is still under review. Now, this is curious because in more than one SLPs that have been filed before the Honorable Supreme Court, the Honorable Supreme Court has actually said that, look, as per the CPC, till the time we review it and change our view, this decision is binding upon the revenue, and therefore you should follow this thing. Having said so, and there are several of such, CPCs, Bentley Nevada, there is Grace Mac, and so on and so forth. Yet, what we see is that even till very recently, the revenue has not actually been implementing ESC in its while they're passing the draft assessment order, which means that your clients, which might be earning license fees, are still probably going to battle, will probably still have to wait for this battle to get over. Why? Because this is something which is present right now before the Honorable Supreme Court under a review petition. The controversy, what was the controversy? Just a quick snapshot. Well, a ton of payments are being made by Indian payers, Indian businesses, for different kinds of softwares. Now, when you are paying for a software, you actually are not interested in, to be able to copy the software and sell it. Nothing of that sort. You just want to use the software. So essentially, what you are paying for is a copyrighted product and not the copyright. And that was the sum and substance of the decision, which was finally passed by the Honorable Supreme Court in the case of engineering analysis. Actually, there were a lot of decisions. EAC is how we abbreviate the whole decision as, and the Supreme Court actually held that this transaction does not qualify as royalty, which means in the absence of an Indian permanent establishment, this is not taxable in India at all. Presently, as I mentioned, this matter is pending before the Honorable Supreme Court. Uh, now, what is the development across the world around this controversy? So this controversy is not just brewing in India. Interestingly, this is something which has been brewing across the world in different forms and fashion. I'm giving you a couple of examples here. One example, Kingdom of Saudi Arabia. It has recently, I mean, ZAPTA has recently, its tax authority has recently issued a guideline in which it has categorized the software transaction into 5 categories. And depending upon which category do you fall in, you may not be taxable at all, or your transaction may be taxable as royalty. In certain cases, there is a divergence vis-a-vis what we generally experience here in India. For example, if the payment is for an online database, then if the database contains private information, proprietary information, it will be royalty, yes. But when it does not, in that case, more often than not, what we see is that the Indian judiciary approaches that it's not taxable in India. What Zatka interestingly is saying is that it will fall into that last category, which is other services, and will still be taxable in Saudi Arabia, I think at the rate of 15%. So what I'm trying to convey is that almost all the economies are extremely sensitive to the fact that a ton of payments go out of their economy to non-residents, to foreign companies, on account of these software license fees. Everybody wants to tax them in some form of fashion. The question is what's fair and what's not. Let's look at what happened just across the border with our friendly neighbors, Pakistan. Interestingly, very recently, they also passed a decision at a Supreme Court level Personally, I found that decision somewhat curious because number one, in the decision, the Supreme Court of Pakistan said that firstly, the taxpayer could have settled this controversy by invoking MAP. Why did it not invoke MAP, mutual agreement procedure, which is an option given in the treaty? As I mentioned, it's an option. You can't force it upon the taxpayer. And therefore, if the taxpayer has not opted for it, that should not affect the judiciary's point of view. And yet, I feel that that has significantly affected the point of view which the Supreme Court of Pakistan has taken in its decision. The other very interesting thing that they've done is that they have said that why is anybody bothered about it anyway? Because even if we deduct some tax here in Pakistan, this is a case of a Dutch taxpayer. Then under the Dutch-Pakistan treaty, the taxpayer will anyway get a foreign tax credit in Netherlands. So why do we bother so much? Which is actually odd because most of the countries, including Netherlands, have the position that only if you have paid the tax rightly, so in the source country, then we'll give you a foreign tax credit in the resident state. Otherwise, we won't. Therefore, we take a position that hey, it doesn't matter that you pay tax over here or not, because ultimately you will get the credit in the resident state. It's strange it's coming from at the level of the Supreme Court of Pakistan, but I personally feel it's technically not necessarily the right position. Interestingly, there was a dissenting view in which the judge who authored the dissenting view actually referred to the Indian advanced ruling on a similar fact pattern and actually held that this transaction is not taxable as per. Anyway, so this was about the controversy which constantly keeps brewing about software payment. We are moving on to the next controversy, which SP Saab just now referred to. This is the controversy in the context of most favored nations clause. While I will give you a quick snapshot in a minute or two about what the controversy was about, but let me first tell you why we are talking about it. How does it affect you? Why is this relevant? Why this controversy still lives on, in spite of the fact that there's a Supreme Court decision on the matter. Firstly, let's face it, MFN clause, most favored nation clause, is something on which a lot of taxpayers have relied all this time in past. A lot of payers, while deducting tax, a lot of Indian payers, Indian residents, when they are making payment across border remittance, in a lot of cases, they have relied upon in past upon the most favored nation clause, which is stated in some treaties, typically in the protocol of the treaties, right? And therefore, suddenly, all of these people, right, whether the people who are earning income, the foreign entities, or the people who are deducting taxes, the Indian payers, they have been told that you were wrong all this while. It significantly affects even the future costs or pricing of these transactions. And therefore, I think personally, it was anyway clear to me from the very beginning that a review petition will be filed, and it has been filed, which is the reason why this is still a controversy which still brews on. Plus, in past, several high courts have ruled on this exact issue in favor of the taxpayer. So now this decision of the Honorable Supreme Court of India in the case of Nestle SA, which went against the taxpayer, I'm not surprised that it's under review. What is the issue? Let's quickly talk about the issue. Also, I'll not take more than a couple of minutes to give you this snapshot. So basically, this is about a unique clause which is in the which is called the MFN clause, which is not present in all the treaties. It's present in a few treaties. What this clause typically does is that if there's a particular status, particular rate of tax which is given in a treaty, a particular definition which is given in a particular treaty, it allows that rate to be reduced, or it allows that definition to become more restrictive than what is stated in that treaty. Why? Because in a later treaty, India gave the benefit of a lower rate of tax or a more restrictive scope or definition in a later treaty, as I mentioned, right? A lot of time, the condition is that the benefit of that later treaty, the subsequent treaty, let's call it the second treaty, will be given to the residents of the country with which the first treaty was entered into, provided the second treaty has been entered into with an OECD member country. Yeah. So to give an example, for instance, India has entered into tax treaties with Netherlands, France, and Switzerland, which gives a particular rate of tax at which India can tax transactions such as dividends, interest, royalties, and paid to Dutch resident, French resident, and Swiss residents. But the rate which is given in these respective treaties, can I invoke a rate lower than that treaty? Interestingly, yes. Why? Because each of these treaties have at the end in the protocol an innocent clause, a most favored nation clause, which says that if India enters into a treaty with an OECD country and that treaty gives a lower rate of tax in respect of dividend interest royalty of TS, then that lower rate of tax will apply to even Dutch residents, French residents, Swiss residents. Now, as a result, in a number of cases, the treaty which was entered into between India and three other countries, Colombia, Slovenia, and Lithuania. India, Colombia, India, Slovenia, India, Lithuania, three treaties. This became an interesting treaty because these treaties contain a much lower rate of tax than the rate which is stated in India Dutch treaty, India French treaty, India Swiss treaty. No. And that rate of tax tends to be 5%, right? So interesting, very good saving. What's the challenge here? The challenge is that firstly, when India entered into its tax treaty with Colombia or with Slovenia or with Lithuania, at the time, none of these three countries were OECD members. Whereas its treaty, which the MFN clause in the first three treaties that I'm referring to, it says that this clause will apply only to treaties with OECD members countries. So, which means should they be OECD members at the point of time when India entered into the treaty with these three countries, Colombia, Slovenia, and Lithuania? Or should they be OECD members when we are trying to apply the MFN clause? Yeah. Second question was, and very importantly, second question was that all of these MFN clauses are mentioned in what we call the protocol to the double taxation of the settlement. Protocol is like an amendment, right? Which is next towards the end of a treaty. Now the question is, without notifying that particular MFN clause, uh, can the taxpayers still avail, without Indian government notifying that particular MFN clause, can the foreign residents still avail the benefit of the MFN clause? Interestingly, Delhi High Court in a couple of decisions actually held that yeah, absolutely you can, because protocol automatically becomes applicable once a treaty itself is notified. There's no need for a separate notification. Uh, However, this issue traveled till the Honorable Supreme Court of India, and it actually said that no, you need a mandatory notification, a separate notification for the protocol. There's nothing like automatic application of this preferential, preferential tax rate under the MFN clause. And secondly, the relevant date on which the country with which the second treaty has been entered into, should have become an OECD member in order to qualify for the application of the MFN clause. That relevant date is not the date when you're applying the MFN clause, but the date on which its treaty was entered into with India. That means in case of Lithuania, Colombia, Slovenia, their treaties are no good for the purpose of invoking the MFN clause of Netherlands, of Switzerland, of France, because at the point of time when Indian government entered into its tax treaty with Lithuania, with Slovenia, with these three countries, then at that time none of these three countries were OECD members. Now, uh, this issue is now before the Honorable Supreme Court under a review petition in which Mr. Salve is arguing it on five grounds. Firstly, the Vienna Convention has not been applied properly. Secondly, there's no need to notify the MFN benefit. And why is that so? Because if we do that, essentially what we are saying is that because of a domestic tax law procedure, we are denying you the benefit of something which is there in the international law. And that will be an override of pacta sunt servanda, of good faith clause in applying the tax treaties. Also, interestingly, the one of the ground is what is the definition of is, right? Because when the word is is to be interpreted in the context of the point of time when the second treaty's counterparty should be an OECD member. There, Mr. Salve has pointed out that there are certain treaties in which it's written in black and white that the other party with which the MFN clause has to be invoked should be an OECD member from day one itself. So if there are already such treaties which say so in black and white fashion, then the other treaties in which this condition is missing, then why should we unnecessarily read this condition into those treaties which do not state so at all, right? Another very interesting argument is that look, the Indian companies are benefiting from the Dutch India Netherlands treaty. Then why should the Dutch companies not benefit from the same clause in the India Netherlands treaty? Meaning thereby that when an Indian shareholder is earning dividend from a Dutch investee, it is enjoying a 5% tax rate because Netherlands is honoring this exemption clause. Then why is it that India choose not? That brings a disharmony in the interpretation of tax treaty. So again, very interesting set of arguments here. Let's see which way does the Honorable Supreme Court finally take the position. This is one of those decisions, as Smita was mentioning a little while back, which has actually invoked a lot of feelings and emotions in the tax experts across the country and outside, because this is not necessarily on those lines which a lot of experts were expecting it to be on. We are moving on to a third decision. This decision is the decision in the case of Hayat UAE, to be more precise. And this decision is important because it tells us that a concept such as permanent establishment, and this is a concept which has been in vogue for more than a century, right? And yet, how it is to be implemented, and we are talking about the base rupee. We are not even talking about any new kind of sophisticated PE, such as a virtual presence service PE, as was discussed in the case of ABB or Z. Nothing fancy, plain and simple, basic rupee. Even that definition is something, the contours of which keep evolving, the way they are going to be interpreted by courts will keep evolving. What's this controversy about? In this case, here has an Emirati company, a UAE company, which entered into certain sets of agreement with a third party in India. The name of the third party is Asian Hotels Limited. It's an Indian company. Hyatt has entered into a strategic oversight services agreement (SOSA) with this Asian Hotels Limited, in which the idea is Hyatt UAE will provide day-to-day management and technical assistance for the maintenance of the hotel. It has received certain service payments from this company, and the question is that are these service payment do they have any element of royalty or not, right? They've also entered into a few other agreements, such as the trademark agreement and so on and so forth. I'll touch upon. So the core question was that does this transaction contain an element of royalty or not? The other interesting question was that can we say that Asian Hotels Limited, or at least the premises of Hyatt in India, they constitute a fixed place PE for the international, the UAE company. Now, first question would naturally be that what is this gone on? Here UAE is receiving service fees, right? Why should service fees have some element of royalty, right? See, the idea is one can envisage that this service payment also includes a clause that permits the Indian hotel to use the health trademark. And let's face it, when you are booking a hotel, online or otherwise, then a trademark such as here does bring in bookings, right? So therefore, is that element of royalty or not in it? Now, that's what brings to my mind a decision which was passed by the Australian Supreme Court, Federal Court, uh, November, right, barely 4 5 months back. This was passed in the case of PepsiCo, right, in which PepsiCo is basically receiving payments for selling concentrate, the cold drink concentrates, right? And a part of the purchase price which was being received, sale price which was being received by PepsiCo was held by the Australian Supreme Court to be in the nature of royalty because there is an element for use of intangibles. So similarly, therefore, the question arises that is there any element of royalty in the service payments that UAE is receiving? Also, let's look at it this way. There are reasons why maybe the Indian tax authorities had apprehensions that this entire arrangement is a somewhat structured one. Now, why would that be the case? Firstly, naturally, Hayat UAE is arguing that look, no part of this transaction is royalty. It is all consultancy service, and UAE treaty happens to have no clause, FTS clause, which would tax in India the fees for such consultancy service. So maybe this treaty has been chosen particularly for this reason. Secondly, interestingly, UAE entity was at a loss at its UAE level, which means that even if a permanent establishment is constituted, the SSC argued in this case, that fine, how does it matter? Because what are you going to attribute to India? We are at a loss, so you can attribute some part of the loss to India. So by attributing any loss to India, it's not as if you're going to collect any taxes from us, right? Thirdly, if you go more into the details of the factual details, actually, back in 1993, there was one single agreement which was there between UAE and Asian hotels, but it was split up into multiple agreements. As I mentioned, SOSA, there was another agreement which was HOSA, Hotel Operations Agreement, Services Agreement. There was a technical services agreement. There was a trademark license agreement. One of these agreements was with Hayat India, right? Through which Hayat India was also allowed to play some role, and we'll talk about that. So, because of all of this, one can imagine that perhaps the Indian tax authorities were suspicious that the entire arrangement is a structured one. Either ways, the point remains that these two questions are pertinent, and what was concluded by the Honorable Delhi High Court is that fine, this transaction does not constitute royalty. It's not, right? But Health has a fixed place PE in India, and which means that any income which is attributable to the PE in India will be taxable in India. So, firstly, why did the Honorable Delhi High Court hold the position that Health UAE has a fixed place PE in India? Firstly, it was held that there are a lot of activities at the hotel on which Health UAE is exercising a great deal of control by way of its rights to frame the policies for the Indian hotel and for implementing. Also, as I mentioned, there was a specific agreement with the assessee's affiliate, that is here India, through which, as per the Honorable Delhi High Court, the day-to-day operations of the hotel were placed under the control of Health India. And thirdly, very curiously, in fact, the Honorable High Court held that look, the employees of Hayat UAE, they can come to India at any time. Hayat UAE has a discretion to send its employees to India at its will without seeking any concurrence from the hotel, the Indian hotel. And it therefore came to the conclusion that because it can send, has it actually sent? That's a different thing. But because it can send employees to the Indian hotel, that alone means that the premises of the Indian hotel are at the disposal of Hayat UAE, and therefore that creates a fixed place PE. This is pretty interesting because a lot of factual aspects and a lot of legal aspects. We'll talk about those legal aspects in 2 minutes. Are the ones which probably could have been looked into in greater detail. Also, interestingly, on the second question, that even if Hayat UAE has a PE in India, how can you tax any part of its income in India because it has no positive income? It has a negative income. It has a loss. So can any part of loss be attributed to India and be taxed in India? This can't be taxed, right? On this, the High Court appears to be lining up with the view that since a PE is a separate tax person, it has to operate on an arm's length basis with the, let's use the word, the head office, in UAE. And therefore, even if the head office has incurred a loss, It does not necessarily mean that the operations, the FAR of the Indian permanent standard also deserves to be attributed only at the loss level and cannot earn a profit. And therefore, on that matter, it has left the door open. Yeah. Uh, and this matter will probably be decided by a larger bench. Now, the issue is that right now, what's the present status? Uh, the assessor in this case has sought a stay on this judgment on four key grounds. Firstly, in the entire decision, nobody has talked about any clear demarcated place which is actually at the disposal of KRQE, because SSC had at no point of time any actual right to use a hotel premises. Just because it can send employees without asking, or at least that's how it is written in the agreement, does not necessarily mean that it has absolute right of disposal, right? Secondly, even if some employees are sent to the Indian hotel, the point is that their visit is supposed to only ensure that the international standards of quality which we are sort of represent, they are being met. In a sense of speaking, that sort of reminds us about the stewardship argument which was taken and accepted by the Honorable Supreme, taken before the Honorable Supreme Court and accepted by it in the case of Morgan Stanley. Thirdly, and in a very factual sense of speaking, health is insisting that absolutely no day-to-day control was being exercised, and therefore it was only providing consultancy service. It is to be seen which way does the court finally take its decision. But this decision, I believe, will travel for some good length of time, because it is probably resetting the entire contours of the PE related litigation. Interestingly, there already exists a decision of the Honorable Delhi High Court in the case of Sheridan, where it has talked about the taxation as royalty or not, as this case was, but PE is one additional angle which we need to look into. I'm moving to another decision. And why is this decision relevant? A very simple reason. India is a country in which there are a lot of creative minds. All of these creative minds are getting inspired by Shark Tank, inspired by all those buzzing valuations that we see on the third page of Economics Times. A lot of these people therefore go out and they set up a new domain. They take a new domain name. Some is a lot of time to a foreign company for this domain name registration. If this transaction is in the nature of royalties, then it means you are required to deduct tax when you're making payment. And mind you, this section which requires deduction of tax from payments made to non-residents such as royalties, section 195, it has no monetary threshold of 10,000, 20,000, 30,000, 1,80,000. No. Even if it is for $100, tax is required to be deducted. It applies even if you are making a payment for personal purpose. For example, you are setting up a hobby blog, right? It does not matter that even if you are making a payment as a businessman, you are not covered by the tax audit rules, tax audit provisions. So therefore, the question is this transaction of registering a new domain name and the payment that you're making for it, is this something which is taxable as royalties? Interestingly, at some point of time in the Indian jurisprudence, in the case of GoDaddy.com, it was held that yes, it is, but now the Delhi High Court has differed from this, has actually disagreed from this position, and it has said not really. Because let's face it, first of all, a new domain name is not a trademark. GoDaddy is not the owner of the domain name. It's only an intermediary which is providing these services of helping you with registering the domain name with ICANN, with the registry. So there are usually three parties in this transaction. That is registry, ICANN, and in this case, GoDaddy. So it's basically acting as a registrar. It has no ownership rights, and therefore it has no ability to give any right in the domain name. It's just simply providing services. The decision of the ITAT, which was against the assessee, was based upon, curiously, a couple of other decisions, one in the case of Satyam Infoway, other which is not appearing on the slide in the case of Tata. But for both of them, the Delhi High Court held that they're not really applicable in the instant case. Particularly for Satyam, it highlighted that that decision was in the context of the rights of the domain name owner, not the rights of the registrar. And therefore, it's not really applicable to the facts of the instant case. And therefore, if you are making any payment for registering a new domain name for yourself, for the brilliant startup idea for yourself, first of all, best of luck. And secondly, you don't have to deduct tax from such transaction. Now I'm moving to another controversy, and this controversy is for an important piece of paper. This piece of paper is called the tax residency certificate. How important is a tax residency certificate in determining whether or not a non-resident is eligible to claim the benefits of a tax treaty? Is that all which is required? Can the tax authorities go behind it and start looking at a few other things as well? Now, this is a controversy which has lived on for more than a decade as of now, still lives on actually. See, the issue is that a lot of time we have foreign companies, we have non-residents, which claim the benefit of a tax treaty. And for that purpose, the Indian tax authorities have a suspicion that it's actually a case of treaty shopping, because really speaking, that non-resident, that foreign company, does not actually have a sizable presence, does not have any actual economic presence, commercial presence in that particular jurisdictions, the tax benefit, the benefit of the treaty with which it is claiming. But it's claiming that benefit because it is able to bring a tax residency certificate. Now, can simply having that tax residency certificate be good enough to claim that benefit? Particularly, we are talking about transactions which are of the nature of sale of shares in an Indian company by this non-resident shareholder who's sitting, say, in Mauritius, say, in Singapore. A lot of times we see a lot of decisions in spring of several Supreme Court decisions which say that you have to honor the TRC. We still find that litigation keeps going on this matter. Blackstone is one of those decisions. There are several of them, a few of them, which we find at the tribunal level. I've argued one personally, but this Delhi High Court decision is a one in which a Singaporean company, again, sold the shares of an Indian company, claimed capital gain exemption based upon the Singapore Treaty. And in order to invoke the Singapore Treaty, it said that I have the TRC. So you understand the chain that what I'm talking about, right? TRC है तो treaty है, and treaty है तो exemption है. So the question was that is this good enough or not? In this case, interestingly, this benefit was thought to be denied by the revenue through a reassessment notice, right? And therefore, in this decision, the question of whether or not the reassessment has been initiated properly was also a legal point. But from an international tax perspective, the conclusion which was drawn by the Honorable Delhi High Court was that, look, TRC is statutorily the only evidence that is required for claiming the treaty benefit. Also, that your own press release, the Finance Ministry's own press release, says that TRC is acceptable as the evidence of tax residence. And it's said that tax authorities cannot go behind the TRC, not in a run-of-the-mill way. Now, this is something which is a controversy because this is still something which is pending before the Honorable Supreme Court. Revenue has filed an SLP, it has filed a also against this Delhi High Court decision, in response to which an interim stay has been granted. The matter is listed in coming months before the Supreme Court. Now, why is this important? This is important because assume that this decision is reversed and the Supreme Court says that no, you can go behind the TRC as well. That means a lot of FIIs, FPIs, a lot of investor community, which has been availing the benefit of treaties which India has entered into with Mauritius, with Singapore, all of those will face a tough time in claiming the benefits, the exemption which is there. in the Mauritius Treaty, in the Singapore Treaty. And mind you, a lot of those exemptions still live on in spite of the changes in the Mauritius Treaty or in the Singapore Treaty because there are grandfathering clauses in these treaties. Again, this is not something which is only unique to India. There are countries where this similar controversy has been brewing. I've given you here an example of the apex court's of the Peru's Supreme Court decision. In this decision, the question was of a transaction between Peru and Brazil, and here the question was again that in the domestic tax law of Peru, it's written that a tax residency certificate is required at the time of accounting for the transaction as well, at the time of payment as well, and not just at the time of ultimate application. Whereas the treaty between Peru and Brazil, it does not have this condition as regards the point of time when the TRC should be available. Interestingly, the Supreme Court of Peru said that look, whatever is written in the domestic tax law, it's cool, but we can't overlook the commitment that we have made under the treaty. If in the treaty this requirement does not exist, what requirement? That the TRC should be furnished before the payment is made in order to avail the treaty benefit, right? That requirement is not there in the treaty, then we cannot force it by invoking the domestic tax law because that will mean we are violating our international commitment. We are violating the principle of Descent Servanda. You will notice this is actually a principle which is it's the argument which is pretty stale, as the argument which Mr. Salve has invoked against the Nestle decision before the Supreme Court in his review petition, where he also claims that we are actually overlooking the rules of the international law by forcing the requirement of a domestic notification, which is an internal procedure. Give me a second. I'm getting a call here, and the true caller says, "Oh wow!" The true caller says, "This caller is." Oh, sorry, I can't rely upon true caller, can I? Because the true caller says that I'm getting the call from Barack Obama. But hold on. Let's not start trusting true callers so much. Why? This is an anecdotal decision. This is not something which creates a groundbreaking new decision, nothing like that. It's simply an anecdotal decision. I'm just sharing with you in next 60 seconds. We all know that non-residents typically who do not have a mobile phone number in their tax return, they state the mobile number to be 999 and one more double nine, right? It's pretty common. But interestingly, this phone number, this mobile phone number, became the bone of contention when Abu Dhabi Investment Authority tried to avail an exemption under India UAE Treaty under Article 24. And it was denied because the Indian tax authorities they took a position that let's look up this number, right? 999 on Truecaller, and no surprises, they didn't find any this number registered against Abu Dhabi Investment Authority, and therefore the Indian tax authorities took a position that this number is incorrect, and therefore the investment authority is also not a real entity. They probably thought of it as a sham entity, which is surprisingly so because actually the Abu Dhabi Investment Authority furnished its registration certificate at FPR. It's not FBR, it's FPR. My apologies for the typo here. It also furnished a TRC, and yet this was entirely overlooked by the Indian authorities. Thankfully, however, the tribunal prevailed and they said that please ignore Truecaller. That's not the right way of looking at it. And the Abu Dhabi Investment Authority is a functionary of the government of the UAE, and therefore it is very much eligible for the benefit of the India UAE treaty, in spite of the fact that its phone number has so many nines, in fact, only nines in it. So all of your clients which are non-residents and are using this number, I think you can rest easy. All right. So we have so far talked about the developments which have happened so far in India. Now we'll talk a bit about the developments which have happened outside India, and yet they're extremely relevant for your Indian businesses, for your Indian clients. because they are happening in those countries which are important trade partners or economic partners. We were talking about India, Mauritius, and India, Singapore routes. So let's talk about the developments which have happened recently in respect of these two routes. India Mauritius Treaty, it has its own share of roller coaster stories. Um, when the multilateral instrument was introduced by the OECD G20, then India said that by all means we are open to even the Mauritius Treaty being subjected to the multilateral instrument. That means India notified its treaty with Mauritius that fine, it can be a CTA if Mauritius chooses so, but Mauritius did not do so. Mauritius signed the MLI in 2017, but its Indian treaty was not notified by it, and therefore, all this time, the treaty between India and Mauritius is not a covered tax agreement. But recently, Mauritius cabinet has sort of announced, it has come out with a public release. I think Indian government has also released, or Indian press release exists, press briefing exists, in which it has talked about several protocols or several developments in the relationship between India and Mauritius. One of which is a protocol which will be signed amending the India-Mauritius Treaty. And the idea is that since Mauritius did not enter into the MLI, which was Indian treaty, then in order to meet its BEPS commitments, the commitment that it will meet the BEPS minimum standards through bilateral negotiation, it is now honoring that commitment and it is now agreeing to sign the protocol to India-Mauritius Treaty. What does it mean? All of the jargon, what does it ultimately mean? It is basically the most important outcome apart from the application of arbitration and MAP clause. The most important outcome now is that the India-Mauritius Treaty will contain an LOB rule and a principal purpose test. Now, this is extremely important. What's a principal purpose test? A principal purpose test is that any of the clauses of the treaty, any of the articles of the treaty, any of the benefits given in the treaty, not just the benefit in respect of capital gain, all the benefits given in the treaty, they can be denied if one of the principal purposes, not the principal purpose, one of the principal purposes of a transaction or an arrangement appears to be, or rationally, that we want to avail unduly the advantage of India-Mauritius Treaty when as such we are not eligible for it unless we meet a test called the objective purpose test. So the bottom line here is a lot of investors who, who have invested into India using the Mauritius route, so far they were enjoying the benefit of the India-Mauritius Treaty, again by furnishing the TRC, which I mentioned is a separate controversy. But at least more often than not, we were seeing that the TRC was getting an upper hand in the ultimate judicial battle. Now, the question will be that will they be able to enjoy simply the same very benefit only by furnishing the TRC, or will they now have to meet this additional test, the principal purpose test? Yes. The principal purpose test will now sit on it. Secondly, practically speaking, the treaty override can be achieved by invoking GAR. But the important point is, GAR is a set of provision which is in the domestic tax law, which has a very robust mechanism which works as a checks and balances on the Indian Revenue Authority. So a tax officer who wants to invoke GAR, he has to seek the permission of the CIT, he has to present a case before the GAR panel, get an okay from the GAR panel, then and then alone it can invoke GAR provisions to override a tax treaty. However, there is no such procedural requirement to invoke the principal purpose test which is given in the treaties, and now that test will form place for all the provisions in the Mauritius Treaty. And as a result, it will be somewhat easier for the Indian tax authorities to invoke the principal purpose test in the context of all those transactions in respect of which Mauritius investors are availing the India-Mauritius Treaty. Also, let's see what has changed at the Singapore level. Singapore has traditionally always been known that while it has a 17% tax rate, it does not apply taxes on capital gains income, particularly on sale of foreign assets. Now, that's something which has changed. From 1st of January 2024, now any sale of foreign assets, including foreign shares, most importantly, actually foreign shares, such as the shares of an Indian company, they can be taxed in Singapore if the Singapore shareholder which is selling those shares does not meet the economic substance test under the laws of Singapore, which means, simply stated, that if Singapore feels that the Singapore shareholder is basically a sham, then the capital gain earned by it on selling shares in an Indian company could be taxed in Singapore, which means all those companies which have an investment holding structure, or for that matter, even an IP holding structure, and which are using India Singapore Treaty or benefit of the Singaporean domestic tax law, most importantly, not just the treaty part, they should review their existing holding structures. Singapore has also announced a few new provisions in its latest budget. A lot of countries are trying to ensure that their local residents get a higher share in the employment. This is a flavor all across. We work very closely with UAE and Middle East in general. So they have an equalization or amortization requirement. Similarly, Singapore has announced a corporate tax rebate of 50%, which basically means that for every employee who's a local to Singapore, and that is also a way of there's also a way of measuring what you mean by local, you will get a 50%, rebate in your corporate tax bill. Not just that, you actually get a cash rebate also. I think it is 2,000 Singapore dollar for every such employee, and this number will be counted along with into calculating the 50% overall CIT rebate. The overall, I think, limit for this is 40,000 Singapore dollars, so which means about 45 lakh Indian rupees, give or take. So that's one single year's saving. There are other very interesting developments, such as refundable investment credits and so on and so forth. But one more important development is that, like a lot of other countries which are introducing in their domestic tax laws certain new provisions to meet the global minimum tax program of inclusive framework of the OECD G20, Singapore has also introduced income inclusion rule and domestic top-up tax to the MTD uh, from the financial years beginning on after 1st of Jan next year, 2025, which means any Singapore headquartered groups that are not paying fair share of taxes outside of Singapore, they will now be taxed at a Singapore level anyway in respect of the taxes that they have not suffered outside of Singapore. Similarly, any of those companies which are sitting inside Singapore, even if they're headquartered outside Singapore, if they are not paying a tax at the effective tax rate of 15%, then a top-up tax will be applied to them, so that their effective tax rate is 15%. But this will not apply to all the companies. That will apply only to those companies which meet a particular turnover threshold, which is fairly high. I talked about UAE, so there are two developments which have happened at the UAE level. Let's also quickly look at that. As you might already be aware, UAE has introduced a corporate tax law. That law has gone live with effect from 1st of June 2023. That means any taxpayer which has a financial year which begins on or after 1st of June 2023, most of the people over there have a financial year which is a calendar year. So therefore, practically from 1st of Jan 24, they will be now required to pay corporate tax. The corporate tax rate is 9% after the first 375,000 dirham worth of income. There are some benefits which are available to free zone entities, but not all free zone entities are tax free, right? But the point is, all this time, there was no panic, there was no compelling deadline which was staring at us in our face to obtain a corporate tax registration. So far, the deadline for which was really far off. It was actually that before filing a return, just obtain the tax registration number. And the first tax return is the deadline for the first tax return, say for a company which is following a calendar year financial year, that is the year from January 24 to December 24, is September 25. So we had a lot of time to obtain corporate tax registration. Mind you, this registration is required even for foreign companies that have some presence, maybe a PE in UAE, right? Now that deadline has come a lot closer. Why? Because UAE has announced multiple deadlines based upon what's the month in which you got your first trade license, right? The earliest of the deadline is, I believe, May of this year, right? So basically, what I'm saying is that the companies, basically taxpayers, are now required to obtain CTR in much quicker. The deadline depends upon your trade license date or trade license month. The earliest deadline, as I mentioned, is May, and if you do not register, the penalty is 10,000 dirham, about 225,000 rupees, give or take. And as I mentioned, please be mindful that even if you're a foreign company, such as an Indian company, and if you have a footprint in the UAE such that you qualify as a non-resident of the UAE under the UAE corporate tax law, you are required to obtain a corporate tax registration under the UAE corporate tax law. Another change has happened at the emirate level. What I was telling you still now was at the federal level, at the whole of the country of UAE. The next change that I'm talking about has something which has happened only in one emirate, which is the Emirate of Dubai, where just like Abu Dhabi already had all this while a tax for foreign banks which are present in Abu Dhabi, now Dubai has also similarly introduced a tax for foreign banks which are operating in Dubai. And for this, the rate of tax is 20%. Now, there will be two taxes. There's a 9% tax and a 20% tax. How will they interact? Secondly, Dubai has this, free zone, which is the hub for financial services sector, which is DIFC. Anybody that is sitting in DIFC, that is not going to be subject to this 20% rate. Any other place in Dubai, free zone or mainland, doesn't matter. If you are a foreign bank in Dubai, in any other place that is other than DIFC, you'll be subject to this 20% tax. But the 9% corporate tax that I was talking about just now, that gets adjusted against the 20% limit. That means it's not that you'll be paying a 29% tax. No, the overall tax is going to have a ceiling of 20%. The penalties are to be notified, but they can go as high as 500,000 dirham. These were about the changes in the UAE corporate tax law. What else? Okay, we are talking about international taxation. Let's touch upon in next 20 seconds about what's happening at the US level. Of course, right now, US is literally buzzing with energy because of the elections. What are the things which are being announced as proposals, tax proposals? This time, the current president, Mr. Biden, has announced that it's time to raise the minimum level of corporate taxes. Mr. Trump had the tax cut jobs act, had brought it down. But now President Biden is saying that it should be brought up to at least 21% so that every big corporation pays its fair share of taxes. Please do note that it is much higher than the global minimum tax rate percentage of 15%. There's also a high level proposal to have a minimum tax of 25% being applied on billionaires. These are the changes which have happened at the global level in those, or expected to happen in case of US, in those countries which are important trade partners, economic partners of India. Let's see what is happening at an OECD level. SP Saab mentioned at the beginning about Pillar 1 and Pillar 2. These are the two pillars which now form the backbone of BEPS 1.0. BEPS 1.0 had those 15 action plans. Now, on top of it, we have these two pillars. The idea is that market jurisdictions, India is a good market jurisdiction, which were claiming that, look, just because a foreign company does not have a fixed presence here, it does not require to set up a shop here, does not mean that you will not pay any tax in here. Something has to be done about it. Therefore, some part of the taxes should be, some part of taxing rights should be reallocated to market jurisdictions. That is the theme of Pillar 1, for which a lot of developments have happened. I'll talk about that on the next slide. Pillar 2 is the global minimum tax project, which basically is the one which has led to what I was talking about just now at Singapore level, the introduction of income inclusion rules and domestic minimum top-up tax in the Singapore 2024 budget. In fact, even the Indian budget this year, there were enough discussions on whether similar rules will be introduced in the Indian tax laws also, because the Pillar 2 basically requires introduction of these rules through the domestic tax law, not through a treaty, not through a multilateral convention. The IIR and the top-up tax are to be introduced in the domestic tax law, because this was an on-account budget. Therefore, uh, not surprisingly, quite frankly, these rules were not announced in the February 2024 budget, but uh, are they going to be announced once the government is formed? I personally feel there's every likelihood, but let's see how things shape up. Essentially, the idea is that all those multinational groups that at a global level, right, all their constituent entities put together at a global level have a turnover of 750 million euros or more. They should pay tax in each of the respective jurisdictions at the minimum rate of at least 15%. There's a particular way of calculating this thing. This will not be computed based upon the taxable income under the domestic tax law. It will be based upon the IFRS provisions with some adjustments, although those adjustments are supposed to be kept to minimum only for permanent differences, certain permanent differences. And there will be certain substance-based exclusions when computing this top-up tax. But if in the local jurisdiction one is not paying even 15% tax, then the top-up tax of 15% will be applied by the local jurisdiction. And if it does not, then fine, whatever tax the local jurisdiction is not collecting will still be required to be paid at the ultimate parent entity jurisdiction or jurisdictions by the ultimate parent entity through a mechanism through which its income will be computed in a deeming manner. And this will be implemented through a rule called income inclusion rule. Now, what has happened so far in the last few months? Firstly, in October of last year, a global minimum tax handbook has been released. There's a multilateral convention about Amount A. Now, this is again something which goes back to Pillar 1. As I mentioned, Pillar 1 is basically about how to reallocate the taxing rights to market jurisdictions such as again India. So how would that happen? Now, that will require a multilateral convention. This is not going to happen only through the domestic tax law. And a multilateral convention draft has already been introduced, has already been released for Amount A. There's also a guidance for Globe rules. This is Pillar 2 in December 23. A timeline for finalization for this multilateral convention has also been decided, and most recently, Amount B, which is the other part of Pillar 1, has also been, what's going to be the text of the multilateral convention for Amount B has also been released. Now, interestingly, Amount A is something which will apply to only some super large companies which meet certain thresholds. In case of Amount B, that's not necessarily the case. So a lot of people I know feel that Pillar 1, etc., is not going to affect me, my clients, my company, because Pillar 1 applies only to super large companies. Well, in respect of Amount B, countries are allowed that if you want, you can apply Amount B even to smallish entities, comparatively smallish than the ones to which Amount A will apply. And if they choose so, then how would the distribution function be remunerated? How would transfer pricing principles apply? Is something which Amount B deals with. This is an extremely interesting area of international taxation. ICAI is already, DTC is already lining up a lot of webinars, seminars, learning sessions on Amount A and Amount B. So I will not be able to do justice in next 5, 10, 15, 20, even 30 minutes because these require a lot of deep dive. So therefore, I think I will I will now look at what are the yeah that brings me to the close of this discussion. I hand over the controls back to you, Grishma, and take it away. Thank you.
Thank you, Gaurav sir, for delivering such an insightful presentation. We will now commence our question answer session, and we will try to accommodate as many questions as possible and request Gaurav sir or SP Singh sir to address the questions that I'll be putting across them. So the first question is with regard to the pillar 2 implementation, and the question is, will pillar 2 have an impact on bilateral investment treaties that India has with other countries?
Bilateral investment treaties. I personally don't think so. But I think it's a layered question. It's a multi-layered question. I would actually prefer that SP sir also shares his insight about this aspect.
As Gaurav explained, pillar one, pillar two will become reality only when these multilateral conventions are reached. Our countries enter into that. And once the countries adopt pillar one and pillar two through the multilateral convention, then in that case, so far as tax is concerned, I think those will be superseding other agreements until and unless there is a specific prohibition in respect of that. So, as it appears today, this is not going to be overridden by the multilateral conventions, but one will have to see how these multilateral conventions are worded and how the countries are agreeing together for the purpose of implementation of the two-pillar approach. Because at the end of the day, if you look at the whole purpose of two-pillar approach is that the countries want to tax the digital transactions, and they know that the internet facilities and all those things are making it very easy for avoiding presence in any location for the purpose of taxation. So those are the things which are being sought to be overridden by the two-pillar approach, and that is why it is divided pillar one and pillar two. Pillar two is basically trying to ensure that wherever there is the income being generated in that country, a certain minimum level of tax is paid by the companies, and they want to ensure that this doesn't become too onerous for the companies, and therefore set off and all the three parameters which have been mentioned by Gaurav have to be taken into account simultaneously to determine the total amount of tax payable. So let us see the actual, because as on today, even if India has in its domestic law, until and unless the tax treaties recognize pillar one, pillar two as such, and the process to implement them, it will not be possible to apply them. But once multilateral conventions are entered into where India is the signatory and our significant, trade partners are signatories, then in that case, these two will become actual reality for the purpose of taxation in India.
Thank you, sir. The next question pertains to the recent judgment on MFN clause. The question is whether there is a risk of tax demands on assessee who have taken benefit of MSN clause, and what measures are available for the assessees.
Yeah, it's a very real question. It's a question which is there in everybody's mind. Well, the principle actually is all those issues which have already got settled, that is, all those matters which are not presently open anywhere at any forum, they should not be reopened based upon the Supreme Court decision. There are views, of course, which are contrary to this position. There are views which say that a Supreme Court's decision, if not followed, is a mistake happening from record, and so on and so forth. But I personally feel this will apply only in context of those matters which are open at any forum. So therefore, what I'm saying is assume there's a particular issue, there's a particular assessment here's appeal, which is right now pending before any forum at ITAT and High Court. In that case, in that unlucky case, the decision of on the Supreme Court in SA will prevail, will apply to that unlucky SSE, and will therefore have a case of rejection of the MFN clause. But all those courts which are cases which have already got settled, your matter is not pending before anybody, none of that. In that case, I feel you don't face that. You don't face that risk. There should not be any proceeding which is of a reassessment or a reopening based upon the Supreme Court decision invoking such demands. That's my personal view. Sir, can you throw some light on your view on this?
No, I agree with you because it's quite a controversial issue. Whether 147 can be applied on the basis of the decision of the Supreme Court in case of assessments which are settled. There is no dispute agreed. The position has been agreed between taxpayer and the tax authorities. Those are the things which, if you look at, I mean, it's taxes at the end of the day, not the only thing which the government gets from taxpayers. It's the investment of and employment opportunities and other, I mean, addition to the GDP, which sometimes become more important. You don't have to kill the hen to get all the golden eggs in one go. So it's very, very important. I mean, at the policy level, I mean, some decision has to be taken not to reopen only for the sake of reopening on the basis of the decision of the Honorable Supreme Court, where the matter has been settled.
Awesome.
Yeah.
Yeah. Next question also pertains to recent judgment on TRC decision, where the question is, should 15 CB or lower or no deduction of tax be done based on TRC? No PE declaration in Form 10F. This question is also relevant considering PPT will now be relevant in case of Mauritius on signing the protocol.
Yeah, again though it's one of those questions which apply on in a real life scenario, right? That when I'm issuing a 15 CB, then do I issue a 15 CB even if the non-resident party is not even furnishing a TRC? I frankly do not advise in favor of that. I know that there are a few decisions, Ahmedabad, Bangalore, etc., in which it has been stated that a treaty benefit can be given even in the absence of TRC, but those were very specific circumstances. Point number one. Point number two, the treaty is a forward-looking exercise, not a backward-looking exercise. You're not doing a post-mortem. I would therefore never advise that. And I know sometimes it might be impractical. That one of the questions typically that I get is, "What is the second paper, right? How does my client bring a TRC for this year, right? When it also follows a financial year, which is from April to March, when it countries also follows tax year, which is from April to March, are you expecting me to bring a TRC on second day of the year? Is that possible? I know those are practical issues. Yet, my answer to this question, I'm afraid, is that the review of 15 CVs is something which appears right there at the top of CBT's action plan on international taxation year after year, consistently. And therefore, a lot of our clients have got notices asking them to justify multiple notices, asking them to justify the position that were taken in 15 CBs. So I would not advise that ignore the TRC, ignore the tariff for that matter when issuing 15 CB. Yeah. Grishma, what was the second part of your question?
The second part of the question was that even considering that Mauritius will be signing the protocol and therefore PPT will soon be implemented in Mauritius itself, so the TRC will lose its value. So in that case, also whether TRC will be applicable or not, and should what all other documents should be taken.
And this is such an incredibly important question, Grishma, because I find that more often than not, I'm not saying everybody, but more often than not, TRCs, 15 CBs are being issued in a somewhat casual manner or in a somewhat too routine a manner, if that's the word that I'm looking for. And this thing brings out how much of a responsibility is there on a chartered accountant when he is issuing 15 CB. Basically, you are issuing an opinion, you are signing it, you're setting it up into the system of the tax office, knowing that, as I mentioned, CBDT action plan says it in black and white that it is highly likely to be questioned by, or at least to be looked in by the tax authorities. And yet, it's something which is being done in a somewhat routine manner. With these new additional requirements that we'll have to be careful of, that should I or shouldn't I bother about the possible invocation of principal purpose test. Now, as a certifier, if you can see yourself that a transaction is such which does not meet any commercial logic, then can you say that I'm not sitting in the chair of an assessing officer and therefore I completely ignore the principal purpose test? Would that be treated as a reckless on the part of such a person who's certifying it? Will it be treated as a misconduct by the regulatory authorities? Um, can the tax authorities also take an action against the person so certifying? I personally think these are very important questions, and my advice would be to err on the side of caution. Therefore, to answer your question now in finally one word, yes, that if uh, we are issuing a 15 CB, should we be mindful of even the principal purpose test? Man says yes, absolutely. If you see that there's a very tangible risk that the transaction or the structure doesn't meet any commercial logic, you are walking into a landmine-ridden space if you're still issuing a 15 CB, ignoring. Yeah.
Other question relates to significant economic presence. The question is which transaction should be reported in significant economic presence? And a follow-on question that we have received on the same topic is that whether by claiming DTA benefit, can one just issue Form 15 CA and avoid paying tax based on significant economic presence concept?
Typically, avoid the word avoid paying tax. Right? Let me put it this way. First of all, which kind of transactions are covered under significant economic presence? Practically all kinds. Why? Because I know that when the whole thing started, at that time we were talking about transactions which are there in the space of digital economy. Yeah. Yet, if we actually go through the definition of significant economic presence, we have to be mindful that that definition actually does not contain anything to that effect. And therefore, we clearly know that the revenue is not going to be taking this position that we'll apply the concept of significant economic presence only to those transactions which are in the digital space and not to pure brick and mortar business. So I know, therefore, it creates a lot of practical issues. So we have clients which are buying, ore, which are importing raw material, and they're single, such transaction, single purchase order (PO) is multiple times the threshold which is given for significant economic presence. And therefore, by one single transaction, there's a very every likelihood that an SCP will be triggered for the non-resident seller, supplier. Also, in a lot of those cases, the transactions are with countries which are not treaty countries, right? And even if they are treaty countries, again, the question is maybe we don't have the TRC on day one, or right now we don't have the TRC. Those are the issues which will now hound the industry, already has started actually. When they reach these stages of assessment and so on and so forth, then this thing will become more real. But the answer to this question is that SCP is something that you just can't ignore as such. But yes, thankfully, in the budget speech with Jaitley had said that the SEP provisions will not apply so long as you are eligible to claim the treaty provisions. So again, if you are eligible to claim treaty provisions, that means you have a valid TRC, you have a 10F, you do not trigger a PPT or an LOB, then yes, SEP provisions will not kick in, and therefore you will not be paying taxes in India only on account of the SEP provisions. But where you're not that lucky, you need to really work it out.
Thank you, Gaurav. Another question relates to Pillar 2 implementation. So, will Pillar 2 will be relevant in India where headline tax rate is higher than 15%?
It's a good question. See, could two things. First of all, let's understand. Pinnacle has two aspects, right? One is QDMTT, other is IIR. From an IIR perspective, it is certainly relevant. What I'm basically saying is, for all those groups, Indian headquartered groups, right, which have a presence outside India in those jurisdictions where the ETR is less than 15%, then Indian exchequer will have a right to collect the differential tax, the top-up tax, at an India level from the Indian bank. Therefore, this is a very black and white scenario in which uh, the income inclusion rules, the Pillar 2 rules, will have application for India. Practically speaking, however, if you look at what the OECD says that, look, we want all the tax havens to be, we don't want the concept of tax, which means all of those countries, all of those jurisdictions which presently do not have that 15% rate will sooner or later be bringing the top of taxes at their respective level, in which case the Indian IRRs will seldom be involved. The second part, will India be really collecting top-up taxes? That possibility is somewhat less. Uh, we can look at whether or not those entities which are enjoying some or other kind of tax incentive, tax holiday, which brings its effective tax rate less than 15%, can they be subject to top-up tax? But more often than not, I suspect, I personally feel that you would probably find that there would be some carve-outs, more carve-outs from the application of PDMTT. One of the slides that I showed, although I didn't go into that much detail, there was that even in respect of UAE's free zone 0% tax, OECD has taken a position that, yeah, it's fair, right? So probably maybe that means, and this is speculation, I'm not saying this much, that free zones, even if they're eligible for 0% rate, does not mean that they now get taxed at 15%, but they could. UAE has not spoken very formally. It has come up with only one federal degree of one page effectively. Similarly, in India, all those businesses which are enjoying some other kind of tax holiday, as a result of which their effective rate of tax is not anymore 15%, then the next point would be, you would find that they would probably perhaps be able to avail the substance-based exclusion, which would probably fill the gap between their actual ATR and 15%, and therefore they may not have to pay extra tax. But if they fail to do that too, then yes, even in that scenario, the Pillar 2 norms will be relevant for India. Yeah, I hope that answers the question. I've answered it from two perspectives. IIR first, QDMPT next. Yeah.
Yes. There was that was a real good aspect that you have thrown on that question. Other question is whether capital gains will be taxed in Singapore if resident of Singapore sells listed shares of Indian entity.
Listed shares of Indian entity. So
So
I'm just
resident.
sort of curious. Yeah. So unless we are using all those grandfathering provisions or otherwise, now yes, they're going to be taxable in India. Yeah.
No, they are asking about the taxability in Singapore.
In Singapore, oh no,
Yes.
not really, because unless the Singapore entity is one which does not have economic substance, and that would be really a shame because one have I'm guessing people will restructure. They will relook at their structure, that do they meet or do they not meet the economic substance test, and where they don't, then they should work towards making their structures compliant rather than using sham structures. Nobody wants to encourage that, certainly not us. So therefore, if they meet the substance test, then it will not be taxed at a simple level.
Okay. Another question is, like Hayat Delhi High Court decision on fixed place PE creation, is there a converse ruling in other countries which may probably impact Indian MNCs?
It's a layered question. Firstly, on permanent establishment, there are like a ton of decisions everywhere. So the question is that, is there a decision, contrary decision elsewhere? Uh, Actually, interestingly, yes, there is. But will it affect the Indian taxpayers? I don't know, because the question is, the overseas decisions are at best an aid to interpretation. Naturally, they're not binding on the Indian judiciary. So I won't say that they would directly affect the Indian taxpayers. Yes, if the judiciary finds the decision a good, logical one, reasoned one, then yes, of course, it will probably treat it as a good interpretation, but nothing that will bind the Indian judiciary on this point.
Now that's bring us to the last question. If you can throw some light on what is controlled foreign corporation.
Because this is the last question, at least one of these questions should be answered in a very well-reasoned manner, and therefore the best way to achieve it, if I request SP sir, I will annex at the end if he instructs me to. Sir, over to you.
In fact, this controlled foreign corporation concept is to ensure that income is not diverted to the jurisdictions where there is lower amount of taxation. So they have put certain conditions on that. When India introduces controlled foreign corporate, concept, we'll have to see how, that is worded, because we don't have the law on that. So it will be very difficult to say. Conceptually, I think, Gaurav, you can clarify that this 25% concept is there. The shareholding should be minimum 25% in order to bring, the income of that company into the jurisdiction of the parent company. It's not that a small amount of portfolio investment is going to bring the taxation of this subsidiary into the jurisdiction of the parent company. So, but what we are now observing, this pillar one, pillar two concepts going. Of course, it is not applicable across the business. So, whether it is only limited to the digital transactions, or it will be, in respect of the entities which are operating, in the manufacturing sector or like that. How it's going to work? It's everything is slightly, vague at this point of time. But CFC regulation is such, which if we look at, will become impacts the global, taxation only when the subsidiary is located in a jurisdiction which has very low taxation. Now, gradually, the pressure is on the countries, whether it is the or under the harmful tax practices, action plan, or otherwise too. The countries are being forced to raise their level of taxation in their jurisdictions. So gradually, the use of the CFC regulation, I think, will become less and less as it, compared to the position as on today. Yeah, Gaurav, if you want to add anything.
No, this is complete, sir. As such, I think that if, if pillar two norms get implemented everywhere, there would not be a lot of incentive for multinational corporations to house a passive entity, passive income earning entity in a low tax jurisdiction, because there would be no low tax jurisdiction, which is the background of the CFC regulations. So basically, for those who need some background, I'm just giving you a quick background. Imagine a scenario in which there are three entities headquartered in India. We have an operational entity in another jurisdiction, which is the high tax jurisdiction of fair high, or an moderate tax jurisdiction. So what we do is, we have an intermediate entity sitting somewhere in a low tax and we suck out all the from this acting entity, which is a lot of profits, but we don't want to pay tax in this jurisdiction. So we suck out all these profits into this intermediate entity. How? By saying that, look, it owns the IP, a trademark, those kinds of assets, which allows it to earn passive income. It could also even be just dividend income. So, but dividend is not tax deductible. That's why I'm sort of avoiding it. It could be a very leveraged, it could be a debt located here, so it is earning interest. So basically, I reduce the tax base in the operating entity by taking out all those profits into this entity which is located in a low tax jurisdiction. And nothing gets taxed here because it's a low tax jurisdiction or a low tax jurisdiction. Nothing gets taxed here because I've reduced its profit by payouts to the intermediate entity. But when this payment will come to the parent entity, then it will get taxed. Yes? When? And therefore, if we do not bring any income here at all, that means it will never get taxed. This is tax deferral. In order to tax this income, CFC norms basically create a naming fiction that this income has been declared as a dividend to the ultimate parent entity, and therefore, at the parent entity level, this income still gets taxed. There are some six golden rules which are sort of stated by the OECD Next Action Plan about how to devise CFC rules, because these rules are supposed to be devised in the domestic tax law. A lot of countries already have. Also, see, the point is there are multiple views around these things. Some people hold the view that Indian poem anyway takes care of this problem. Why? Because essentially CFC rules apply to those entities which are passive entities, right? And they are controlled by the parents sitting in my case, in India, right? But come to think of it, if the entire control is in India and the entity overseas is a passive entity, that means it's not carrying out active business outside India, ABOI, which is the test for poem. And therefore, why just some part of its income through a dealing fiction, but all of its income will get taxed here because of the residency rule, right? Over a rate of 40% if it's a company. So there are multiple views about its interpretation, and that's the beauty of tax laws. The first question which was asked here was the impact of pillar 1, pillar 2 on BPA. Quite frankly, I don't want to sort of trigger a controversy here, but there are views around that also that actually all of that goes against, they contradict with international investment agreement. I don't want to stop that controversy because that will take us on a completely different road. What I said was my personal view that, I don't think so, but, maybe my view will change too. But similarly, in the context of CFCs, I think there are multiple views that India talked about introducing CFCs in the DTC era, right? Direct tax code era. And of course, nobody can throw more light about direct taxes than SP sir. Now, is that going to be introduced or not? It's a waiting game.
$1 million question. In fact, I think there is no question. So I will uh, talk about some concept which Gaurav has discussed. If we look at apart from the permanent establishment, the other issue which is going to draw the attention of everybody is the royalty, taxation of royalty. Because after the limitations in respect of the payment of royalty has been removed, the amount of royalty being paid out of India has increased. So that is bringing, attention of the tax authorities about, whether they are able to tax all types of royalty or not. So one has to be very, very careful in looking at the taxability of royalty, the conditions which have to be fulfilled before the tax authority can say that this is taxable or not taxable. And in that, the decision of the Honorable Supreme Court in case of engineering analysis has laid down certain rules very, very clearly. And if you look at the decision of GoDaddy uh, and read engineering analysis together, there are certain things which will be, common to both of them. And the thing is that when we say that something is royalty, the basic concept is that what type of the rights are being transferred from A to B. Are all rights being transferred or part of rights being transferred, and the owner is retaining some crucial elements of the rights associated with any intangible? That becomes very, very important. And whenever any agreement is analyzed or agreement is structured, at that point of time, these aspects have to be kept in mind. There will be, litigation. It's not going to stop whether there is a review or no review. The payment of royalty is going to draw attention because at times, it forms a very big amount in the profit and loss account of the Indian entity. So one has to be very, very careful structuring, the agreement, what type of right are being given to the licensee by the licensor, what type of the controls are being retained by the licensor. Those will become very important. And to know what are the important elements, I would suggest, those who are interested in studying, because Pius ji has said in the beginning that the ICI is looking for research paper. I mean, one can think of writing research paper on royalty. Of course, there are books on royalties, but research paper, considering I mean the recent developments, you need to study it, and you need to I mean advise your clients accordingly after duly considering the views which have been expressed by the Supreme Court and the High Court. Yeah. Will you like to add anything, Gaurav? Hello.
To improve upon perfection. So I
Yes.
will try to improve upon perfection.
Over to you, Garishma.
Yeah. Thank you, SP Singh Sirji and Mr. Gaurav for such an incredibly insightful session, and knowledge that you have thrown upon on recent case laws, and having a thorough discussion on all the recent developments that is happening around Pillar 1, Pillar 2 development, and also recent all the amendments that is happening at treaty level. So that was really a great session. And Gaurav, your presentation was truly enlightening, and we extend a sincere gratitude for sharing your such a wealth of knowledge. We would also like to express our appreciation to Mr. Piyush Chachad, Chairman of DTC, and the entire DTC team to conduct such a wonderful presentation on such topics. And we request to have such discussions and such topics more, so to enlighten all of us. And thank you once again, the entire team, for this session.
Thank you.